The second biggest bank collapse in U.S. history.
The collapse of Silicon Valley Bank.
A rough week for the banking industry.
Get ready for some shocking news. Silicon Valley Bank, the 16th largest bank in America, has just gone bust. Yes, you heard that right. The same bank that had $212 billion in assets and a market capital of $16 billion as recently as Friday, March the 10th, 2023, is now no more. This is without a doubt the biggest bank failure since the global financial crisis in 2008, and its effects are just terrible. But what exactly does this mean for you and the economy at large? Well, let me break it down for you. With billions of dollars now stranded, the collapse of Silicon Valley Bank will have a ripple effect that will be felt across the financial world. This failure will have an effect on everyone, from businesses to investors, and that's why it's important to stay informed about this event and how it could impact your finances. In this video, we'll take a deep dive into the collapse of Silicon Valley Bank and explore its causes, consequences, and what it could mean for the future of banking. We'll look at the role of regulators, how investors and businesses are affected, and what the long-term effects of this terrible event might be. So get ready for a mind-blowing ride as we look at one of the most important bank failures in modern history. Don't forget to hit that subscribe button and turn on notifications so you never miss out on any of our future updates. Let's take a journey back into the early 1980s when a game of poker between two friends sparked the birth of Silicon Valley Bank, SVB. Founded in 1983, the bank's primary goal was to secure deposits from investor-backed companies, which quickly grew to include a range of services to keep clients even after their startup phases. Even though real estate loans caused problems in the early 1990s, SVB kept going and grew to finance more than just technology. In fact, it even financed the wine industry. As the dot-com bubble burst in the early 2000s, many financial institutions failed, but SVB continued to grow under the leadership of CEO Ken Wilcox, who kept the bank true to its mission of serving IT firms. SVB now offers private banking services and has opened offices in Bangalore, London, Beijing, and Israel. But it was during the 2007 to 2008 financial crisis that SVB truly shone. The federal government loaned the bank $235 million through the TARP program, and in just 2 years, SVB paid it back. This proved that SVB's dedication to its customers is strong and is always innovating to find new ways to serve the technology community. Under CEO Greg Becker, SVB continued to make waves by teaming up with the Shanghai Pudong Development Bank to support startups in China, even using the renminbi currency. With SVB's innovative spirit and commitment to its customers, it's no surprise that it became a key player in the banking world. Let's explore what happened to the Silicon Valley Bank. This bank was a go-to for tech startups and established businesses in the tech sector. Many of these companies and their employees deposited their hard-earned money into SVB, and some even took out loans from the bank. As of December 2022, SVB had amassed over $200 billion in assets, making it one of the top 20 largest banks in the United States. However, things took a turn for the worse when the Federal Reserve began rapidly raising policy rates in 2022, going from essentially 0% to 5% in just 1 year. Companies that needed money found it harder to do so because, among many other things, tech stocks and digital assets were sold off, and cryptocurrency exchanges shut down. Because rates went up, SVB and other banks saw the value of their existing bonds go down as well. Usually, it wasn't too hard to wait until the bonds ran out and the principal was paid back. However, many banks chose to buy bonds with longer maturities because shorter-term debt securities didn't earn much during the low-rate period. Unfortunately, many of these longer-term bond holdings are now worthless due to the Fed's rapid rate hikes. Customers of banks like SVB began withdrawing their money when they heard about the problems with the bank's balance sheets. To keep up with the demand, SVB had to offload $21 billion in loss-making longer-term U.S. government bonds and mortgage-backed securities. This led to a real loss for the bank of about $1.8 billion, and when the plans to raise money through an IPO on Thursday, March 9, 2023, were made public, the bank run got worse. Peter Thiel's founder fund told all of its portfolio companies to close their accounts with SVB. So the FDIC stepped in to protect depositors and made sure that as much as possible that the bank's assets were returned to depositors. Unfortunately, this could destroy the value of the shares owned by SVB Financial Group, the parent company of the bank. It's a cautionary tale, really, a reminder that even the biggest and most successful institutions can fail in uncertain times. It's important to keep a watchful eye on the markets and stay informed about the state of your investments. However, SVB was unique among financial institutions in three critical ways. First, its deposits were more vulnerable to fluctuations in interest rates than its assets. Second, its customers were mostly big businesses, which were more price-conscious than small retail customers. Lastly, SVB was the first big bank in terms of how much its total assets were invested in securities, 55%. Most banks have large portfolios of variable rate loans, which means that interest payments go up as rates go up. The FDIC released a statement that insured depositors of Silicon Valley Bank, SVB, would be able to access their deposits by Monday, March 13, 2023 morning. This news came as a relief to insured depositors. The FDIC also announced that the branch offices of SVB would resume operations under regulatory supervision. As per the FDIC's standard insurance policy, depositors are eligible for coverage of up to $250,000 per bank per account ownership category. This means that all insured depositors now have full access to their insured deposits, providing some peace of mind during this challenging time. However, there is still some uncertainty regarding the fate of 89% of the bank's $175 billion in deposits that were uninsured as of the end of 2022. But fear not, as the FDIC is working tirelessly to find another bank that is willing to merge with Silicon Valley Bank over the weekend. This would provide a lifeline to those uninsured depositors who may be feeling anxious. In the meantime, SVB Financial, the parent company of Silicon Valley Bank, is leaving no stone unturned to find buyers for its other assets. Investment bank SVB Securities, wealth manager Boston Private, and equity research firm MoffettNathanson are all up for grabs. And with the help of investment bank Centerview Partners and law firm Sullivan & Cromwell, SVB Financial is confident of finding the right buyers for these assets. Even though it's a difficult time for SVB stakeholders, the FDIC and SVB Financial are making encouraging efforts to find solutions and potential buyers. Rest assured, you will be updated as the situation progresses. While the collapse of Silicon Valley Bank, SVB, has raised concerns about the stability of the banking systems, there is little reason to worry about the possibility of further financial institutions failing. With SVB's assets accounting for just 0.91% of all U.S. banking assets, it is unlikely that its failure will have a major impact on the other financial institutions. However, SVB's demise does highlight the vulnerability of many banks' investment portfolios. If interest rates keep going up, as the Federal Reserve has said they will, U.S. banks' investment portfolios will continue to lose value, which could hurt their ability to stay in business. Nonetheless, most banks will still have enough capital to handle these losses. This is because after the 2008 financial crisis, the Fed worked to make sure that the financial industry could handle any storm. So the banking system remains stable for the time being. While further financial failures cannot be ruled out entirely, the likelihood of such an event happening is small, and even if it does, the system is equipped to handle it. In the middle of all the talk and uncertainty about what will happen to Silicon Valley Bank, an interesting rumor has popped up. Could Tesla's mysterious CEO Elon Musk swoop in and buy the bank? The idea gained momentum on Saturday, March 11, 2023, when Musk publicly stated that he would be willing to consider such a move. Elon's one follower tweeted, "I think Twitter should buy SVB and become a digital bank." In response to this, Musk wrote, "I'm open to the idea." When Elon Musk made comments on Twitter about buying the defunct Silicon Valley Bank, SVB, they went viral and sparked a flurry of responses from online users. Some suggested that it could be a huge boost for Twitter's potential as a bank, while others made light-hearted jokes about keeping Musk occupied. What are your thoughts on the possibility of Twitter becoming a digital bank? Do you believe it could be successful, especially if Elon Musk owned it? Let us know in the comments section below. As we wait to see the fate of SVB and its stakeholders, the possibility of tech giants like Tesla and Twitter entering the banking industry raises interesting questions about the future of finance. What other disruptors might emerge in this rapidly evolving landscape? Stay tuned and keep an eye on the latest developments in the financial sector.